Awesome. Welcome, everyone. We're going to be talking about the 2024 Venture Rebound today and things that you can do to take advantage of this unique moment in time. Before I begin with the presentation, I want to talk to you about a story that I heard this morning. So we're a limited partner in a number of funds. We have a fund of funds, which invests in funds. And one of the funds we invested in is early stage, and they back companies, almost like an accelerator. And one of their companies this morning has got very good news, and we're checking out the data right now. But they may have gotten up to 1,000x markup in under a year. Okay. So we don't know the exact number. It's a few hundred X to 1,000x markup in under a year. And why do I open the 2024 Venture Rebound session with that story? Because there's not too many times in history where investors can get 100x to 1,000x in a very short period of time. In fact, the only other time in history where that happened was at the dawn of the internet in the early 90s to 2000. I created personally two separate billion-dollar companies in that time frame. And back then, $1 billion was a lot of money. Now, $1 trillion is a lot of money. But, so what we're seeing today is this very similar dynamic to what we saw only once before in history, which was, again, around that dot-com boom, where entrepreneurs could take an idea and get 50x, 100x, 1,000x in a short period of time. And, one of the companies that I did back in that era did get 1,000x. I remember one of my investors brought some people in to the deal. They got 1,000x, and they bought my investor a Porsche as a gift. And I was always like, why'd they buy you a Porsche? They should buy me a Porsche. I was the one that, did the company. You were just an investor. But we're seeing that type of dynamic happening right now. And I'll be talking through that and what it means to you. But before I do, I just want to make this point super emphatic and super clear. This is a seminal moment in the history of venture capital where you can do things that may never be able to be done again for decades or ever. Okay? And so you can get the returns, you can make career-making investments, you can do things right now that are just not able to be done in other market environments. All right. And so, this is a very unique time. You should seriously take advantage of it. Let me share with you some of my insights, lessons, and thoughts on ways that you can benefit from the current market conditions. So, there's definitely a venture rebound going on right now. I would just say that you're not going to hear this in the media. And at this point, it's safe to say that the media is a giant steaming turd. It's off on everything that's reporting. If it says things are good, they might be good, they might be bad. Don't know. If it says things are bad, they might be bad, they might be good. Don't know. The media is just not the place where you should be looking for information on the current market conditions. And I'll give you a simple example. A lot of times the media cites numbers from PitchBook, and we know PitchBook very well. We know the data very well, and it's tempting even for us to source data from PitchBook because PitchBook data is kind of widely out there, but PitchBook data is garbage. Okay? People don't, it's based on surveys. People don't fill the surveys out correctly. And then analysts extrapolate based on those surveys to guess what the market's like. So it's bad data in, super young analysts guessing, and then that's purported as truth. Okay? We actually have systems that venture capitalists use to run their firms and funds. And as part of our terms of use, we get to aggregate the data and talk about it. And the stuff that we're seeing bears no resemblance to anything that we see in PitchBook. And again, PitchBook is one of the major sources quoted in the media for all their analysis and research. So if you read it in the media, just disregard it. I'm going to tell you what we're seeing in the market right now, like this almost 1000x deal just today. And so I'm going to give you the unvarnished, unfiltered reality of what's happening. Okay. And so 2024 right now is literally poised to be one of the best years, if not the best year ever in venture capital, period. Okay. Better than the internet, better than social, better than 2009 when Uber, Space, all these things came out. It's literally one of the best times, if not the best time in history. So and here's the thing, vintage years matter, okay? The single most important determinant in a fund's success is not if they're top decile or bottom decile. That matters a lot, right? But it's the year, because a middling fund in a good year will be better than a top fund in a bad year, okay? Because for whatever reason, companies that are amazing come out around the same time. And it's clearly one of those times right now, okay? So let's say you invest in 2024 and this happens to be one of those golden vintage years. And let's say another one of you procrastinates and comes out in 2025, which is not as good as 2024. The 2024 fund, even if it doesn't perform as comparatively well as the 2025 fund to the vintage year peers, may be heads above in terms of the money produced because it's in a better vintage year. It's that simple. This is fact. It's known by all limited partners, all research agencies, everybody. And it's because seminal companies get formed in groups, usually in a vintage year. Sometimes it's like 1 or 2 years, but it's usually 1 year, okay? And your vintage year is determined by when you form and close your fund, okay? So I think that everyone in their right mind should be looking to form and close this year. So let's talk about why. What's happening? Why is this the case? Well, I mean, first of all, you can read the news, but again, the media is generally not something that's very trustworthy. But pretty much every large company on the planet is laying people off like it's going out of style. I think Elon was somewhat responsible for this. He came into Twitter, he cut thousands of people, and the company functioned fine. In fact, it's probably grown. And a lot of companies are like, wait a minute. And so Google's cutting, Meta's cutting, Apple's cutting, everybody's cutting. And the people they're cutting, the way they're doing it is they're cutting meat, bone, fat, everything. Okay. And amazing people are becoming available to launch startups and to work on in startups, because once they're out of these big companies, they don't want to go back. Again, sorry for a bit of a cold, but and I'm excited about this subject matter. Okay, so you have incredible talent entering the market. like pretty much never before in history, because when the dot-com boom happened in 94, only later in the 90s did smart and talented people start leaving big enterprises. Right now, they're leaving big enterprises because they're getting fired. So you have some of the best talent in history available for young companies, either as founders, co-founders, executives, team members, etc. And if that were not enough, because that would be good enough to be a reason for a boom to begin with, valuations are down, right? Early stage valuations are down. Now, that won't last for much longer. I promise you that. Not when you're seeing 100Xs or 1000Xs, right? Then valuations will go up because an entrepreneur will be like, wait a minute, I just sold at this and now I raised at this. I probably undersold at my, pre-seed and seed round. I should probably raise the prices because I'm giving too much of the company away. But still to this day, valuations are down. And this is a post-pandemic phenomenon because the later stages got crushed. The early stages held their own. But then as the later stages were crushed, eventually the early stages dropped. And we're still in this lower valuation period. So the later stages are lower, but they're now rising. And the earlier stages are lower, and they're going to soon to be to rise. And when there's lower valuations, it's easier to make money as an investor, right? Because if you're getting, the same stock cheaper. And, third, and probably most importantly, there are historic market conditions right now. I look at AI, just AI, not anything else, impact, nothing else, just AI, and it's bigger than the internet. And you look at the internet, and estimates range that the internet affected global GDP between 10 and 30 trillion dollars. Okay. You look at the stock price of NVIDIA at 2 trillion-ish, right? And it's a picks and shovels company for AI. So it's just selling picks and shovels, right? How much is a picks and shovel business? 10%? So that would be a $20 trillion opportunity. 5%? It's not 30%. It's somewhere between 5 and 20% of the. How much should a big picks and shovels business be? 5 to 20%, something like that. So, and I think the market's pricing it against the overall opportunity of AI. So AI is in the tens of trillions of dollars. I think it's going to rival the internet, probably be larger. But that's not all. We have a climate crisis of epic proportions. Epic. We have to do stuff to get out of it. That's also many trillions of dollars that will need to be spent to fix the environment. And then there's more, right? There's just tons of correlated new opportunities. I could go on. But just those two alone represent many tens of trillions of dollars of adjusted and new GDP. So you've got these three amazing things: talent, right? Entering the market at record levels, lower valuations than we've seen in over a decade, or in the lowest in a decade or so, and truly historic market opportunities happening right now. Who cares, right? Well, I'll tell you who cares. Limited partners care. You know who limited partners are? They're the investors in funds. And why do they care? And how do I know they care? Well, I know they care because there's record levels of LP demand that we are seeing right now. Excuse me. And when I say record levels, I'm like, wow, these are really intense amounts of LP demand happening right now. in January, we saw $85.7 million of commitments by limited partners into venture capital funds just through our system. The previous monthly record was around 65 million. So it was 20 million more than our largest month previous to that. When you average January and February, it's larger, or when you add January and February, excuse me, it's larger than any other full quarter we've had in the past. Okay? So you add the 2 months of the year, and February is a short month, and it's larger than any other quarter we've seen. Okay? And then on top of that, cohort 13, excuse me, which is running right now, admissions are open for cohort 14, but cohort 13, they raised $64 million in less than 2 months from just starting with an idea. And that's the largest amount of money that any cohorts raised in under 2 months in the history of the program. And then we launched the LP Institute, which is a training program for LPs. We had around 500 limited partners sign up. We let in only 50, and those 50 limited partners are planning to invest approximately $350 million over the next 12 to 18 months into new and emerging managers alone. So they're going to invest a lot more in other stuff, later stage managers, whatever, real estate, blah, blah, blah. But just in new and emerging managers, they're looking to invest $350 million. And this is 1/10 of the people that apply. Okay? To put $350 million does not seem like a lot, but most new and emerging manager funds are small. 10 million, 25 million, they're not very big. So it's just these numbers are kind of staggering. And the reason limited partners are caring and interested is because new and emerging managers have the best returns. And this is known by everybody. Everyone knows this, right? There are a lot of reasons that LPs don't like new and emerging managers because they're very volatile. Some fight and break up. Some fail to raise their fund. There's all sorts of drama with new and emerging managers. But if you can put up with the drama, you get the best returns possible. You know, good returning funds will get 4x. Great returning funds do much better, right? So you can kind of put up with the drama. You can get anywhere from a 3 to 4x pretty easily by backing new and emerging fund managers, right? So they're very popular right now. New and emerging managers are very, very popular with limited partners at the moment. And so what does this mean? What does all this mean, right? What does it mean to you? What should you do? Well, the next Sequoia is being started right now, okay? And just to give you a lot of people don't realize this. Sequoia really started at the dawn of venture. And you know how big their first fund was? $3 million. All right, a lot of people are like, I got to go launch a $250 million fund. Well, Sequoia started with a $3 million fund. You know, the number one performing fund in the world, according to lore, I think there's actually better performing funds, but no one talks about it because they're prohibited. But the one that people talk about that's kind of public is Lowercase Capital. You know how big their fund one was? That was the number one returning fund? $7 million. They reported as 8.5. I've heard it is 7. I think there's some revisionist history there. They were shooting to raise 10 and they didn't even hit the number. And it still got a 280x return plus, supposedly. So the next Sequoia The next lowercase capital, they're starting now, right now. All right. $1 trillion markets like the internet are being started now. AI, Impact, which we cover, and others are starting now. Okay. And the best way to make money as an investor is to be at the ground floor when $1 trillion markets are being born. And career making deals are being done now. I opened this talking about a fund that we're invested in that is seeing a multi-hundred to 1,000x deal markup in under a year. Okay, those managers have made their career. It's not done yet, so I don't want to jinx it. I'm not going to say who, what, when. But if that deal goes through, those managers are set for life. They'll be able to raise as many funds for as long as they want forever. You know who did that? Benchmark with eBay. eBay came in and pitched a fund that I was advising. The fund hated them. I was like, this is the best deal I've ever seen. It's crazy. So Pierre Omidyar came in and he's like, yeah, I carry a satchel of checks for 10 cents, 5 cents, etc., to the bank a few times a week. And the VCs were like, that's insane. How much does it cost to send a check? They're like 25 cents. And they're like, wait, they're spending 25 cents to send you a check for 7 cents? And he's like, yes. I'm like, that's the best thing ever. What an amazing story. You'll figure out digital payments later. But the fact that they care so much, they send you 7 cents, says everything I need to know. I'm in. And then the other guys were like, no, we can't do it. Benchmark did it. Benchmark that's the deal that put Benchmark in business, right? Career making deals, your whole career as a venture capitalist is going to be based on some deals that are being done right now. Literally right now. And guess what? In 12 months from now, there'll be 5 times as many startups. So it's going to be a lot harder to pick anyone that's good. And the valuations will go up at least 2x. Okay? So now you get 50 startups, you pick one, and you pay 1x the valuation. In a year from now, you have 250 startups. It will be much harder to find the good one, and you're going to pay at least twice as much to get in, right? So it's like dramatically better to do it now. So what's next? What's next for you? Where do you go from here? Well, I'm going to ask you a very simple question. If you're thinking to start a fund, if you're thinking to launch a venture studio, if you're thinking to launch an accelerator that funds its participants, if you're thinking to, go into a family office or fund of funds, if you're not going to do it now, when are you going to do it? Next year? Next 2 years? You missed the entire boat? What's holding you back? Right? Why are you waiting? Like, I can't, I don't know. You tell me. So all you need to do to get started, I'll just walk you through some basic things. And Niels, could you put the thesis link in the chat, please, for everybody? Start by creating a thesis, right? Just make a thesis for your fund, right? Write it down. It's not that hard. It's 1 sentence. It probably will suck and you need to put through 20 versions, but maybe that takes you a month, okay? You'll still be able to close this year. So start with a thesis. Next, source amazing deals. As I said before, it will take you about 50 deals right now to find a winner. How hard is it to find 50 deals? go to local accelerators, go to your local university, attend startup events, hustle. 50 deals is easy. 250 deals is hard, right? But if you're only needing to pick 1 in 50, I'm telling you, it's not it's obviously exponentially easier than picking from 250, but when 1 in 50, not just the odds are better, it's much easier. When you start seeing 250 deals, you're getting false signals all day long, right? Whereas 50 deals, it's a lot more manageable. So all you need next to do is source amazing deals. A lot easier to do right now than in a few months or even a year or beyond from now. And then you raise limited partner capital. And as I just showed you, look, raising money sucks and it's not easy, but it's about as easy as it's going to be right now. Every single limited partner I know, including ourselves, are investing actively at the moment. It took us, excuse me, about 18 months to deploy into 10 deals. And we'll do the next 10 deals in 6 months right now. That's just us. But we're not alone. Every limited partner that I've talked to, every limited partner that I know feels the same way. We're putting money to work right now. We're going into new and emerging managers. Because look, Sequoia and Benchmark and whomever these big players are, they're like behemoths battling it out, right? New and emerging managers are totally unthreatening little scrappy things that a new and emerging manager can invest in a deal that Sequoia and Benchmark are fighting over. And when Sequoia gets in the deal, Benchmark does not. But the little new and emerging manager gets in alongside Sequoia. They get in alongside Benchmark because they're not a threat. So they're the best place to deploy money right now. But it's still not going to be easy. So last but not least, you want to start investing now in 2024. Okay, not in 2025, not in 2026, not in 2027. Now, sure, will there be good opportunities in 25, 26, and 27? Absolutely. Will you be able to make enormous amount of money in those years? Absolutely. Will it be shooting fish in a barrel like it is this year? No. It will be harder. So you're going to have to work harder to raise the money. You're going to have to work harder to deploy the money. You're going to have to work harder to get returns. And I'm not saying it's easy, but it's about as easy as it's ever going to be right now. All right? And I'm not even mildly exaggerating. So I ask, like, again, what are you waiting for? Are you waiting for a sign? Are you waiting for a symbol? Well, let me give you one. Now, okay? Now is the time. Like, you can wait. You're going to be like, second guess, overthink, analyze, paralysis, do analysis, I'm sick. My mom called me. I can't do it right now. My child's going to college. Make all the excuses you want, right? Doesn't hurt me. I don't care. Our numbers are way up. Only hurting you, right? You're procrastinating, right? You're like literally missing being on the most important moment in investing history because you have some reason that you concocted in your head that is not tethered to reality. Maybe you read some article in Wired, which is, again, another steaming pot. By the way, and Wired is about this thin. It's like as thin as like my, ticket. Like, so I read it in Wired. It's saying it's a really bad time. Okay, buddy, you keep procrastinating. No, now is the time. Now. All right. So venture capital is in not only rebounding, it's like bounced 100% back. and we are here to help. Okay, so let's do this. Hopefully that was useful. I covered a lot of stuff. Hopefully we got some questions in the Q&A. It looks like we have precisely 2 questions. Woohoo! So if you have other questions, which by the way, this always happens. So there's a little Q&A button. Click it, add your question. You can also upvote the questions. We're going to go by most upvoted first. Get your question in the Q&A, and I'll in my experience, which is vast on these things, we'll have lots of questions by the end of the Q&A period. So get your questions in earlier for best chance to be answered. Niels, you want to go?
Let's go. Fortunately, the 2 questions are long questions. Adeo, can you please talk about impact more specifically? Stats are estimating that 10% of all investing is impact, and that impact will become mainstream. In Europe, all investments must check impact boxes to move forward, even on the regulation side. Can you speak more about where things are going impact-wise and how this fits with venture capital?
Yeah, again, guys, you have to, everybody here has to just, if you read something, no matter what the source is, just assume it's bullshit. Okay? There, because I can tell you numbers that I have that are not bullshit, because we literally track things, real data in real systems from real users and real LPs, not theoretical data on theoretical research and small pockets. So I just want to give a sense here. We have about 450 firms that have completed our programs and are in market, okay, and using our systems, etc. It's about half of all new manager firms worldwide, but again, there's not really good data on how many new manager firms there are, but you know, we could get a good sense. We're about half, right, because of the scale. And so and then we're about 10-ish% of overall firms, right? We're operating worldwide. And we see those numbers. Now, there are new and emerging managers, so they're smaller, blah, blah, blah. So I can caveat our numbers all day long. And with that said, we're seeing a much higher than 10% of all new and emerging manager firms are focused on impact. You know, and impact's a difficult thing to quantify, because is diversity impact? Is, you know, climate impact? I mean, they all seem to be impact to me. So if you throw in everything that feels like it's impact, it's more than a third of all new and emerging managers are focused on impact, and actually therefore more than a third of all money going into venture right now is going into impact. So you know, impact's large. Now look, there were a lot of shysters in impact. In fact, it's being proven now that a lot of the impact stuff is BS. Like, you know, when you carbon offset flying on planes and stuff, and they're supposed to be planting trees, apparently not many trees were ever planted by those carbon offsetting schemes. In fact, maybe none of the, so a lot of impact limited partners are skeptical about whether the impact that managers are claiming, the impact the companies are doing, the impact of investing in these things are actually happening. So if you're going into the impact field, you've got a high degree of skepticism to overcome with limited partners, with general partners, etc. And so, but with that said, about over a third of new and emerging managers are focusing on impact, and over a third of the dollars are also coming into impact. So it's much larger than anything that you're reading, much more significant than anything that you're seeing. So a lot of the stuff you're hearing is sort of, again, BS.
While we're on the topic of stats, Michael is asking, what percentage of the last 5 cohorts have raised funds and are deploying?
It's not exactly 100%, but it's effectively 100% because we survey every manager, and if they're not actively closing on capital or deploying capital, we remove them from the network. So our grad numbers sort of shrink. So we complete. So the stats are roughly 250 firms start 300 something people, roughly per cohort. Roughly 70, sometimes a little less, sometimes a little more firms finish, right? And then we follow up with everyone, and roughly, again, sometimes less, sometimes not too much more, but around 20% give up. So of the 70-ish firms that finish, we'll check in with them, help them, whatever. And some of them, it could be life circumstances. Someone's family member passes away, they move, all kinds of things happen, and they just stop working on their fund. And when they stop working on their fund, we take them out of the stats. So we're not like tallying up like dead funds in the 450. All 450 funds are actively either finishing their fundraising or in market deploying. So it's effectively 100%.
I'll paraphrase the question from Anna.
Yeah, keep your
Basically,
questions to like, if it's War and Peace, we're gonna have a difficult time answering it. Thank you, Niels.
how
Maybe
do
we could
first
have a chat GPT that turns it into a one-liner.
There we go. How do first-time fund managers pick the right startups?
You know, do we have another hour? Look, it's the very first thing is that you need to have deal flow. If you don't have if you have bad deal flow, you're never going to pick a good startup. So the first thing you need to have is any deal flow, and then you need to have good deal flow. And, look, the broken clock is right twice a day. And I would argue that the story I told of Benchmark, they weren't like particularly amazing or smart. They just got lucky with eBay. I was in a partner meeting and I was advocating for eBay, and everyone else turned it down. And their reasons were legit. Like, what the hell? This company will never scale carrying satchels of 5-cent checks to the bank that cost 25 cents to mail, right? That will never work out. And I'm like, well, yeah, but they're going to solve that problem and then it's going to be huge. And they're like, they may solve it, they may not, right? And that's legitimate points. So sometimes it's just lucky, right? You could just get lucky. You say, I think that problem will be solved. I'll take that bet. That's what Benchmark did, and it made them, a household name. So it was a little bit of luck, absolutely, right? But at the end of the day, you if you have good deal flow, you'll have the highest probability of picking a good deal. If you have bad deal flow, you may never get a good deal. So what I would say, the best thing you can do to win as a new or emerging manager is just make sure that you have good sources of good deal flow that continue to produce interesting opportunities for you to review.
Another question on like due diligence from Jay. When investing in startup where projections usually are not conventional businesses, out of these three, which ones would be the most optimal to look for? Number one, promising product with current market trends such as AI. Number two, founders with perseverance and passion. Or number three, future potential, some entirely new technology.
Yeah, I mean, I mean, all three are somewhat important. I would say the single most important thing to look for when you invest in a company is what's the likelihood that it can raise a large follow-on round, right? And now maybe it's got a great founder and that's why, maybe it's in a promising market and that's why, maybe it's got some future potential and that's why, maybe it has all three and that's why. It's not so much one or the other. It's like, because at the end of the day, and unless you're a late stage investor, and pretty much no one here is, some maybe, but I'm assuming most are not. As an early or even a mid stage investor, the only thing that matters is, can that company raise a subsequent financing round? Yes or no? If it, and the factors that you outlined may be vital to it doing it. So it could be the founder, could be the market, could be the future potential. But at the end of the day, it's your assessment. And a lot of it's like, hey, this guy is kind of pitching me terrible, or this woman's pitching me terrible. I don't really understand their business. I don't think there's a lot of potential. If you have any doubts about it at this round, those doubts are likely to get amplified later on. So I would just walk away. Um, but conversely, if you're excited and like this is going to be pretty large, and wow, I think everyone's going to want to get into this deal, then move quickly on those.
With growing AI regulation, how do you view the impact on AI startups and the subsequent investment landscape?
Yeah, look, the only place that's regulating AI right now is Europe, right? And Europe regulates everything to fail. It's like, hey, crossing the street is, let's regulate it. Okay, you cross like this, not like that, and you gotta and you do 3 steps per minute or less, and like, well, then we'll put laws and like, and member states can put their own crosswalking stuff. It's like, what? Like, yeah, okay. So EU is regulating itself into the dustbin of humanity's relevance. It's like everyone else will be living in a glorious AI future, and they're going to be eating, pan and like foie gras. Okay, enjoy. But yeah, so the only place where EU regulate is where regulations in AI is the EU, and I wouldn't start a business or a fund in the EU if you paid me. Dale, I'm going to give you $1 million to come to the EU and start a fund. No. How about 2 million? Nope. 5? No. Like, it's like, and then you're going to put me in handcuffs, a straitjacket, throw me off a bridge, and give me a straw to survive. No, thank you. And those are the regulations. So outside of the EU, I wouldn't worry about AI regulations at all. Singapore is like, if they're quite the opposite. They're like, we got to get on the AI bandwagon. How do we join? In fact, one of the ministers just gave a big talk. It's like, if we don't move, we're going to miss the boat. Meanwhile, EU is like, we got to keep AI out of here. Like, I don't, it's I can't even, don't get me started. It's going to be a disaster for the EU. I just watched, I like everything the EU does, like, is like the opposite of intelligent.
I will again paraphrase this. Any thoughts on how advisors should be compensated in funds?
Yeah, so Niels posts the venture share. So we have an agreement. So there's no such thing as really advisors in venture funds. They're called venture partners. Okay. And the venture partners are compensated like in a lot of different ways. Actually, every fund kind of does it differently. So we tried to standardize an offer for venture partners, and you could say, hey, what's this venture partner doing? And then it will show you a range of compensation and how to do it in the agreement itself. So we've mapped this all out, outlined it, and made it super easy for you to bring on advisors / venture partners into your fund.
You've mentioned there aren't many good data sources on venture. Rushira is asking, what would be a good source to find data on impact and social entrepreneurs in recent past?
You know, nothing. Look, I wish I could tell you that there was a good source. Like, different people publish different things, and like their data is at best imperfect or bad. Our data is roughly half of new and emerging managers, but it's not 100% of new emerging managers. We encourage people to have small fund sizes. So, our data is not perfect. PitchBook's data is super imperfect. Carta's data is imperfect. So everyone has slices of the pie that are in some cases just plain wrong, like PitchBook, or biased or incorrect or whatever. So, if you want data, you got to go do the work, right? You got to go out there and talk to so there's no, let me just help you. No source of data that you're going to get that's going to give you any insights that's not utter BS. All right. Period. Preqin, Cambridge, PitchBook, all garbage. All right. So if you want data, you got to do the work. The work means you go out, you find companies, you find their press releases, a lot of which are also BS. You talk to the CEOs, you got to form your own opinion and build your own methodology if you want good data. If you want bad data, use PitchBook, use Cambridge, use Preqin, but you're not going to get, things that are, and there's also like Crunchbase. I would say Crunchbase is okay, right? But again, a lot of people lie on their, like to PitchBook, to Crunchbase, to all this stuff about fund sizes. It's not like I'm going to raise a round. I'll use us as an example. I'm going to raise a round. It's maybe 25 million bucks, right? But I've got some safes I'm going to roll into it. So even though I'll announce a $25 million round, the actual size of the round is going to be less than that. And like, who would know? I know. Does that mean that the press will get it wrong? Absolutely. Do I care? No. Like, I'm not the meter of truth for the media, which is already full of bullshit. So like, just everything's sort of BS, and like, you have to take it with a grain of salt. So you're going to have to do your own work to get data that you need to make intelligent decisions.
Again, paraphrasing. Any thoughts on impact carry as a compensation mechanism for GPs?
Impact carry as and I'm not sure what that is. That would be a great question for Decile Base. Everybody, we have maybe put the link into Decile Base. I'm guessing what you mean by impact carry is the idea that there's some additional carry upside by applying certain impact principles to your investment. And here's the problem, and I don't know if you can find this link on our site. It's not certainly in that we have the for progress definition. So we've taken a stab at taking, there's 17 major UN Sustainable Development Goals. Underneath those are 169 sub goals, and we've taken all 169 sub goals and turn them into measurable things that startups can achieve. And we are a for progress company ourselves. And so you can measure, but those things. But again, impact is generally really, really hard to measure. And like tethering impact in economics, like in staggering economics based on impact is I don't think a good idea. If you want to go out and do an impact fund, then your carry is enough. If you're actually investing in impact and you're actually making returns, then the returns are enough. You don't need to jigger anything based on impact. Either you're investing in impact or you're not investing in impact, and then the returns are the returns.
Yeah, she clarified that impact carry is indeed when you're compensated by the amount which you hit your impact targets by. So Honey is saying, not a question, just a fresh update. He he or
She
she
attended Investopia, yeah.
yeah, and at least 5 different high net worth individuals or family offices mentioned that VC Lab the highest respect as a sort of prerequisite to validate emerging funds. So a nice
Yeah,
comment.
so thank you very much for that, Hani. I appreciate that. I know, so look, for us, it's not about money. We're trying to fix the industry first and foremost. Now, it's turning out that by fixing the industry, adding transparency, adding ethical constructs, streamlining the agreements, just literally anything that's broken in the industry today, the level of diversity, the level of inclusion, the level of transparency, the reducing the barriers to entry, we're fixing it all. We're leaving no stone unturned to fix the industry. And it's being now recognized by the best managers realize that they need to be in the VC Lab program. But even more importantly, the best limited partners in the world realize that they should be backing firms that came out of the program because the quality level is so high compared to the average. So, we've always said that we're roughly 50% of the market, and it could be 50% of the worst funds and 50% of the best funds, or we could be the bottom 50% or the top 50%. It looks like we're the top 50% because our best funds are crushing it, right? We had a 1,000x investment today in one of our funds, right? So hopefully we're the best 50%, and we're gonna work to be that way. And I'll tangent on this with one last point, and then we got a couple questions. Should get them to, but like, if we're fixing venture capital and we're making it more ethical because and if those managers win by not a little, by a lot, they're multiple times better than everyone else, then ethical, well-run venture capital is the future. And that's what we hope for. Now, how much would you size up the impact investing industry at today? It's as I said, about a third of all new and emerging managers. And again, it's very hard to get the data, but it's hundreds of billions of dollars are going into venture. A small percentage of that is new and emerging managers, and a third of that, and by small, it's like under 20% are new and emerging managers, and a third of that is going into impact, as far as we can see, right? And what sectors should an investor focus on in the near term other than AI or impact investing? It really depends on you. There's, like as I said, and more. Healthcare is going through a massive leapfrog right now, in part because of machine learning models and innovations, et cetera. There's so many exciting industries. I could spend a whole thing on exciting industries right now. Healthcare being just one of many, on top of AI and impact. But even within healthcare, there is longevity is very interesting right now within healthcare, right? So healthcare itself is such a massive industry. Automotive, right? There's been, real contenders to the large automotive companies coming out that's never been done in almost 100 years until now. So it's when you look across the board, there's innovations happening in so many industries. I think you have to find what you're passionate about first and foremost. So let me leave everyone with this. Okay? I'm not kidding. Now is the time, right? If you're waiting for a sign, there's no better sign than you're going to get right now to start. We're here to help. Everything we do is free. Everything we do is free. Again, it's not about making money for us. It's about fixing everything. We invest in funds, we back managers, we do have some premium stuff that everyone's expected to pay for, like setting up your fund and stuff like that. But pretty much, if we can help you, we're going to help you. No quid pro quo, nothing expected in return. Just we want to see you win and succeed in this market environment. Thank you very much, everyone. Have a great day.
Thank you.